Don't buy one share of Broadcom until you watch this video until the end, because the stocks become one of the biggest winners in the AI infrastructure boom, and the market is treating it like the story still has so much more room to run. I mean, you'd think that a stock that's been up so much would need something massive to keep investors interested. And in Broadcom's case, that's exactly what the company is trying to do. It's not just selling chips, it's selling the kind of custom AI hardware and networking equipment that hyperscalers need if they want to keep building bigger and faster data centers. But the real question is very simple. Is Broadcom's growth strong enough to justify the price that investors are paying today? Well, in this video, I'm going to break down three things. First, why Broadcom's AI revenue is accelerating so fast. Second, why its cash flow and buybacks matter so much right now. And third, what all of that could mean for the stock from here. My name is Rick Orford. I'm a Wall Street Journal bestselling author. I've been trading since 1999, and no, I'm not a financial advisor. That is a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. Broadcom's a global tech company that designs, develops, and supplies semiconductor and infrastructure software solutions. Now, that sounds like a mouthful, and it is. But Broadcom, let's just say, makes the hardware and the software that helps power AI data centers, enterprise software, and networking systems. And that matters because AI doesn't run on hype alone. It needs data centers, it needs networking, it needs custom chips, and it needs companies that actually deliver those pieces at scale. And that's exactly where Broadcom comes in. The company produces networking hardware for data centers along with custom silicon for AI. And because of that, Broadcom's become a key supplier for the hyperscalers. Those are like Meta, Amazon, and Apple. And when these hyperscalers spend aggressively on AI infrastructure, Broadcom can be one of the companies that's sitting right in the middle of that spending cycle. Plus, Broadcom has also expanded into enterprise software through its VMware acquisition. Why would they do that? Well, it gives the company just another vertical because VMware helps clients manage cloud infrastructure and run virtualization software across data centers and servers. So Broadcom isn't just a chip company anymore. It is a semiconductor business, but it's also an AI infrastructure supplier, and it's also an enterprise software company all rolled into one. And that combination is why investors are paying so much attention. Now, Broadcom is starting to see some strong returns on its AI expansion, and that's definitely one of the biggest reasons why investors are willing to support its premium valuation today. The company is in a very strong position to meet hyperscaler demand because its core products are critical components inside AI data centers. And the numbers are starting to show up. Broadcom recently reported that its AI semiconductor revenue alone reached $8.4 billion in the first fiscal quarter of 2026. That was up 106% year over year. And it also beat management's own forecast. So this wasn't just strong growth. This was better than expected growth that doubled. And when a company is already priced for big expectations, beating those expectations becomes very important. Broadcom also saw strong revenue growth as hyperscalers ramped up capital spending on custom AI accelerators and AI networking. Basically, the companies building AI infrastructure are still spending, and Broadcom is benefiting from that spending in a very direct way. With that, the company's net income surged to $7.3 billion, up 34%. Diluted earnings per share came in at $1.50, also up 32%. That just tells me that growth isn't just showing up in revenue. It's also flowing directly to the bottom line. And that's important because AI growth is exciting, but investors want to see real profits. And Broadcom is proving that it can do both. Adjusted EBITDA rose 30% to $13.1 billion, and EBITDA represented 68% of revenue. That is a massive margin. And to me, that suggests three things. Broadcom's got pricing power, its products are in demand, and the business is converting growth into profit very efficiently. And that's exactly what investors like me want to see from a company that's tied to one of the biggest technology spending cycles in the market. But earnings, they're only part of the story because the next piece is cash flow. And this is exactly where Broadcom really starts to stand out. Even though the company's capex reached $250 million in Q1, its free cash flow still grew 33% to get this more than $8 billion. That means 41% of every dollar Broadcom made in revenue turned into pure cash. Think about that for a second. For every dollar that came in, the company kept 41 cents as free cash flow. That's not just growth, that is high quality growth. And that kind of cash flow gives Broadcom a lot of flexibility. It can invest in new business, it can pay dividends, and it can repurchase its shares. And it can keep rewarding investors while still participating in the AI build-out. And Broadcom was able to return $10.9 billion to investors because of its strong cash flow. And that figure included $3.1 billion in cash dividends and $7.8 billion in stock repurchases. So investors aren't just hoping the stock price goes up. They're seeing that management is proving they can return real capital back to its shareholders. And that matters, especially when a stock is trading at such a premium valuation. At the same time, Broadcom's board also approved a new buyback program to repurchase up to $10 billion of Broadcom's common stock. Now, it would make sense if some investors looked at that and said, hey, wait a minute, why buy back the stock after such a big run? But that's exactly what makes this signal so important. This could suggest that management still believes the stock is cheap relative to long-term growth, at least the potential that AI could offer. Of course, buybacks don't guarantee anything, but when a company is generating this much cash and still buying back its own stock, it tells me that management sees plenty of value in the business in the future. Now, looking ahead, management expects this growth momentum to continue into the second quarter. It guided towards revenue of around $22 billion in Q2, and adjusted EBITDA margins are expected to reach 68%. So Broadcom isn't guiding like this was a one-quarter spike. It's guiding like strength continues. And with AI revenue growth accelerating, management also expects AI semiconductor revenue to get to $10.7 billion in Q2. And that is such an important number because if Broadcom can deliver on that number, nearly half of the company's Q2 revenue is going to come from AI semiconductors. And that would mean that AI is no longer just a small part, a side project for Broadcom. It's becoming one of the central drivers of the business's success. But of course, there are risks. It's something that comes up all the time in my community. And I think this is where investors need to be careful. A big portion of Broadcom's AI revenue growth is tied to hyperscaler demand. So if hyperscalers start to slow down their capex or capital spending, or if budgets tighten, Broadcom's revenue may not grow at the same pace that investors expect. And when a stock is priced for strong growth, even a small slowdown can become a big problem. And this could happen if hyperscalers shift from aggressively building out their infrastructure to a more measured spending plan. And that could lead to lower demand for custom chips. And if the market revises its own growth expectations, well, that could leave the stock vulnerable to downside moves. So the risk here isn't that Broadcom suddenly becomes a bad company. The risk is that expectations may already be very high. And when expectations are already high, the company has much less room for disappointment. And then Broadcom is also heavily reliant on just a few large hyperscalers that purchase Broadcom's custom AI chips. And that creates a customer concentration risk. If we look at its latest annual 10K, the company disclosed that its top 5 customers contributed 40% of revenue in fiscal 2025. That's a lot of revenue that's tied to such a small group of customers. I mean, it would be one thing if demand was spread evenly across hundreds of customers. But when a few large buyers drive a major portion of revenue, any change in their spending plans can matter. So investors need to watch hyperscaler budgets very closely. And that's because even if one or two large customers pull back, delay orders, or shift their strategy, Broadcom and their shareholders could feel that impact. Broadcom's custom chips are also competing with GPUs, especially those sold by NVIDIA. And that's another key point. If Broadcom's hyperscaler clients shift towards GPUs, or more towards GPUs, well, Broadcom could see weaker demand for its custom chips business, and that could be a drag on AI semiconductor revenue. Now, it doesn't mean that Broadcom's losing, no, but it does mean that the AI chip market is competitive, because it is. And investors shouldn't assume that every single dollar of AI spending automatically flows to Broadcom. Some of it goes to custom silicon, sure, and some of it goes to networking, and some of it goes to GPUs. And the balance between those categories can change over time. Now, let's talk about the stock. Broadcom has traded between $226 and $442 over the last 52 weeks. And right now, it's trading near the upper end of that range. The stock is up 82% over the last year. And for many investors, that's a sign that the market increasingly sees Broadcom as a key player in AI infrastructure. And honestly, that makes a lot of sense. The company reported strong growth in AI semiconductor revenue, so the market saw it as a validation that Broadcom is executing its AI strategy. And investors aggressively re-rated the stock as hyperscalers continued to spend heavily on AI. And Broadcom's custom AI chip business has been a major beneficiary. But this is where the emotional side of investing gets tricky. Because when a stock is rising fast, it's easy to feel like you're missing out. And I bet you've seen this before, right? A great company reports strong numbers, right? The stock keeps climbing. The story keeps getting bigger. And suddenly, investors feel like they need to buy more before the stock gets even higher. That's called FOMO, or fear of missing out. And it's exactly when valuation matters most. Because a great company can still be a risky stock if investors pay too much. Now, if you've been watching Broadcom but think, look, it's still too expensive, maybe you want to buy it 10 or 15% below where it trades today, check this video up here, because I talk about how you can sell a cash-secured put on a stock you want to own and get paid to wait for it to potentially come down to your price. And if it does, you get to buy it and you got paid to buy it. So with that practical idea in mind, let's look at how the market is valuing the company right now. Broadcom trades at a market cap of nearly $2 trillion. And at this valuation, the stock trades at almost 53 times earnings. That means investors are paying about $53 for every dollar of earnings Broadcom generates. And this is why many investors are asking questions about Broadcom. They're wary, right? The valuation is high. I mean, just look at NVIDIA. It's trading at around 23 times earnings. That is a massive difference. And to me, it tells a very clear story. Investors expect far more growth from Broadcom over the next few years, at least compared to NVIDIA today. The market is effectively pricing Broadcom not as a mature semiconductor company, but as one of the primary beneficiaries of the AI infrastructure buildout. And maybe that's fair. Broadcom has strong AI revenue growth. It has strong free cash flow. It's got massive hyperscaler exposure, and it's returning capital to its shareholders. But at 53 times earnings, the company needs to keep delivering not just good results, strong results, consistent results, better than expected results. Because that's what a premium valuation usually demands. So is now the time to buy Broadcom? Well, consider that a consensus among 42 analysts rate Broadcom a strong buy, and that rating has held over the last 3 months. The average score is 4.74 out of 5. It's near perfect, though it has declined slightly over the same period. Meanwhile, the mean and high target prices suggest that investors could expect between 15 and 52% potential upside over the next year. Now, that does sound attractive, but I don't think investors should just buy a stock because analysts are bullish. I mean, you'd honestly expect better than that, wouldn't you? I think the real question is whether Broadcom's business can keep supporting the valuation. And right now, the business is clearly performing well. Broadcom's AI expansion is starting to pay off. The company is delivering strong returns to shareholders, and the stock continues to perform very well. And investors are seeing solid capital gains. But at the same time, Broadcom is generating strong free cash flow, which has been funding share buybacks and dividends. That's a powerful combination. Growth, cash flow, shareholder returns, and management's own guidance continues to point to solid AI revenue growth. It's expecting $22 billion in revenue in Q2, and nearly half of that is expected to come from AI semiconductors. So AI is still a key growth driver that can drive its earnings. If free cash flow continues to accelerate, the company can keep funding its dividend program and share repurchase programs. And that could give the stock a lot more room to run despite the higher valuation. Of course, this still comes down to what you believe about Broadcom's AI revenue. If you think Broadcom's AI revenue can continue to accelerate, then now might be a good time to buy the stock, especially given the company's track record of dividends and share buybacks. But if you're more concerned that the company may not be able to reach its targets, then it may be best to wait for a pullback before entering in at a better valuation. And that's really the core decision here, right? Broadcom's an excellent business with strong AI momentum, but the stock is already priced like investors expect that momentum to continue. If the growth continues, the premium could be justified, but if it slows down, well, we could see a pullback, and that could happen fast. Now, before I go, I've got a few last questions for you. First, do you believe in what Broadcom is doing? And are you buying or holding or selling the stock? And is there anything else that I should have added to this analysis? Let me know your thoughts in the comments below. And while you're there, if you found the video helpful, don't forget to like and subscribe because it helps others find the video, it supports the channel, and it makes sure that you don't miss out on my next deep dive. Well, that's it for me today. Thank you so much for watching, and I'll see you next time.